If you look closely at what happened in precious metals markets during late 2025, you'll notice a pattern that doesn't align with typical commodity cycles. Silver moved from roughly $29 per ounce in early January to prices exceeding $70 by December. This represents a movement of significant magnitude over a compressed time frame. To understand whether this reflects fundamental market forces or temporary distortion requires examining the underlying structure of how silver is priced, traded, and accumulated. The silver market operates differently from most financial markets because it exists simultaneously as an industrial commodity, a monetary metal, and a derivative instrument. These three functions create competing pressures that don't always resolve in predictable ways. When you study how major financial institutions interact with this market, you begin to see patterns in their positioning that reveal information about how they assess future conditions. Between approximately 2008 and 2020, several major banks faced regulatory action related to their trading practices in precious metals markets. JP Morgan paid over $900 million in settlements related to spoofing practices, which involve placing orders with the intent to cancel them before execution in order to influence price direction. Multiple traders received criminal convictions. These weren't minor infractions. They represented systematic practices that persisted across years. The regulatory findings documented that these institutions were actively influencing price formation through derivative contracts while simultaneously managing large physical positions. What makes recent developments noteworthy is not the historical manipulation itself, but the apparent shift in positioning that occurred in October 2025. Market data indicated that JP Morgan, which had maintained substantial short positions in silver futures for years, appeared to liquidate approximately 200 million ounces worth of short contracts. At the same time, the bank's custodial holdings in COMEX vaults reached approximately 196 million ounces, representing roughly 43% of total registered and eligible stocks. Additionally, as custodian for the largest silver exchange traded fund, the institution controls another 517 million ounces. This creates a concentration of physical metal unlike anything seen in modern commodity markets. The shift from net short to net long positioning by a major market participant carries informational value. Institutions with deep market knowledge and regulatory experience don't typically reverse multi-year positions without reassessing fundamental conditions. The question becomes what changed in their evaluation of supply, demand, and price formation mechanisms. To understand current dynamics, you need to examine three structural factors that distinguish silver from other assets. First, silver functions as both a monetary metal and an industrial input. Unlike gold, which is primarily held as a store of value, approximately 60% of silver demand comes from industrial applications. Solar panel manufacturing, electric vehicle production, electronics fabrication, and data center infrastructure all require silver in quantities that cannot easily be substituted. The Silver Institute reported that industrial demand reached 680.5 million ounces in 2024. Annual mine production sits at roughly 835 million ounces. This creates a structural deficit that has persisted for multiple years. Above-ground inventories can fill these gaps temporarily, but inventories are finite. Second, precious metals respond to real interest rate environments. Real yields represent the nominal interest rate minus the inflation rate. When real yields fall below zero, assets that generate no income but preserve purchasing power become relatively more attractive. During 2025, the Federal Reserve reduced its benchmark rate to a range of 3.75 to 4%. With consumer price inflation persisting above 3%, real yields compress towards zero or negative territory. This environment historically favors monetary metals because the opportunity cost of holding them declines. Third, central bank behavior has shifted measurably over the past several years. Official sector purchases of gold reached record levels in 2022 and 2023. While silver purchases received less attention, Russia announced a $535 million allocation to silver purchases over 3 years. China's Shanghai Gold Exchange has facilitated substantial physical metal accumulation. These aren't speculative trades. Central banks operate with decades-long time horizons. Their accumulation patterns signal a reassessment of portfolio composition and reserve adequacy under changing monetary conditions. When you combine structural deficits in physical supply, compressed real yields, and official sector accumulation, you create conditions where paper-based pricing mechanisms face stress. The derivatives market for silver operates with leverage ratios that far exceed the underlying physical metal available for delivery. COMEX trades contracts representing roughly 300 times the volume of metal in eligible stocks. This system functions smoothly when most participants settle contracts financially rather than demanding physical delivery. But when delivery demand increases relative to available inventory, the pricing mechanism experiences friction. In December 2025, reports emerged from markets in Japan and the United Arab Emirates indicating spot transactions occurring at prices significantly above the COMEX benchmark. Some transactions reportedly cleared above $120 per ounce, while the official COMEX price sat near $72. An 80% premium over the paper price is unusual at this magnitude. Regional premiums exist in commodity markets due to transportation costs and local supply conditions, but premiums of this size typically indicate that participants are willing to pay substantial amounts to secure physical delivery rather than accept financial settlement. This type of price divergence has historical precedent. During periods when derivative markets experience stress, physical markets can decouple from paper markets. The wider the spread between physical and paper prices, the more it suggests that the derivative pricing mechanism is losing its ability to accurately reflect supply and demand for the actual commodity. The margin requirement increases imposed by CME Group in November 2025 provide another data point. Exchanges raise margin requirements when volatility increases, and they need to ensure participants can meet their obligations. 3 margin increases within 3 weeks is an accelerated pace. Higher margins force smaller participants to either post more capital or reduce positions. This concentrates market participation among entities with larger capital bases, which can accelerate existing trends rather than dampen them. For individuals holding retirement savings in traditional portfolios, these dynamics have implications that extend beyond the silver market itself. The standard portfolio construction model used by most Americans allocates approximately 60% to equities and 40% to bonds. This framework performed well during the 4 decades from 1980 to 2020, a period characterized by declining interest rates and relatively stable inflation. Declining rates create favorable conditions for both stocks and bonds simultaneously. That environment appears to be shifting. Interest rates have moved higher from their 2020 lows. Inflation, after remaining subdued for years, has proven more persistent than many forecasters expected. Fiscal deficits have expanded substantially. The ratio of federal debt to GDP has increased. These aren't necessarily crisis conditions, but they do represent a different macroeconomic regime than the one that prevailed during the previous 40 years. When macroeconomic regimes shift, the correlations between different asset classes can change. During the 1970s, stocks and bonds both performed poorly in real terms as inflation eroded purchasing power faster than nominal returns could compensate. Precious metals, by contrast, appreciated substantially during that decade. Silver rose from roughly $1.30 in 1971 to $50 in 1980. Gold increased from $35 to over $800. These weren't smooth upward trajectories. They included extreme volatility, but over the full decade, monetary metals preserved and increased purchasing power while traditional financial assets struggled. The question facing anyone managing wealth today is whether we're entering a similar regime shift. The answer isn't certain. Macroeconomic forecasting is notoriously difficult, but the behavior of large institutional players provides some indication of how sophisticated market participants are positioning for various scenarios. Treasury bonds are often described as safe assets, and in one sense they are. The United States government has never defaulted on its debt obligations, but safety against default is different from safety against inflation. Bonds are contractual claims denominated in dollars. If the dollar loses purchasing power, bonds lose purchasing power proportionally. They provide nominal safety, but not necessarily real safety. Precious metals don't generate cash flows, pay dividends, or offer interest payments, but they also don't carry counterparty risk. Their value doesn't depend on any institution's promise to pay. During periods when confidence in monetary stability weakens, this characteristic becomes relevant. Portfolio construction for most individuals should reflect their specific circumstances, time horizon, and risk tolerance. But certain principles apply broadly. Diversification means holding assets that respond differently to various economic conditions. Stocks and bonds are both financial assets. They're both denominated in currency. During certain periods, they can decline together if the underlying currency experiences stress. Physical assets, productive assets, and financial assets each play different roles. For individuals concerned about monetary regime change, an allocation to precious metals between 5 and 15% of total portfolio value has historically provided meaningful diversification benefit without creating excessive concentration risk. The typical division would allocate more to gold than silver, roughly 70-30, because gold has lower volatility and deeper liquidity. Silver offers greater appreciation potential during periods when both metals are rising, but it also exhibits sharper drawdowns during corrections. The form in which precious metals are held matters. Physical bullion provides maximum independence from financial system disruptions, but requires secure storage and insurance. Exchange-traded funds offer convenience and liquidity, but depend on the custodian's solvency and the financial system's continued functioning. Mining equities provide leverage to metal prices, but introduce operational risk, management quality considerations, and equity market correlation. Most individuals benefit from using dollar-cost averaging when establishing positions in volatile assets. Rather than attempting to time entry points precisely, purchasing fixed dollar amounts at regular intervals reduces the impact of short-term price swings. This approach works particularly well for assets expected to appreciate over multi-year timeframes, but likely to experience significant volatility along the way. Psychological preparation is as important as financial preparation. Silver can rise 50% in 1 month and fall 30% the next. Anyone allocating to precious metals needs emotional discipline to maintain positions through volatility. The objective is long-term purchasing power preservation, not short-term profit maximization. Focus on the time horizon that matches your actual needs rather than reacting to monthly price movements. Nothing described here constitutes specific investment advice tailored to individual circumstances. Financial decisions should reflect personal situations, existing obligations, and future needs. Consulting with qualified professionals who understand your complete financial picture is appropriate before making substantial allocation changes. The broader context extends beyond individual portfolio decisions. What's occurring in silver markets reflects forces operating across the global monetary system. For centuries, dominant reserve currencies have changed. The Spanish silver dollar, the Dutch guilder, the British pound, the American dollar, each held supremacy for a period, then gradually ceded ground to successors. These transitions don't happen abruptly. They unfold across decades. Early signals appear in commodity markets, currency exchange rates, and capital flows long before the transition becomes obvious to general observers. We may be witnessing early stages of the next transition. The dollar remains the world's primary reserve currency by a substantial margin, but its share of global reserves has declined from over 70% in 2000 to approximately 59% in 2024. Central banks have diversified into gold, other currencies, and alternative reserve assets. Trade settlement increasingly occurs in currencies other than dollars, particularly between nations facing sanctions or seeking to reduce dependency on dollar-based payment systems. These shifts don't mean dollar collapse is imminent. Dominant monetary systems can persist far longer than many expect because network effects and institutional inertia create powerful stabilizing forces. But the monopolistic position the dollar held from 1945 through 2000 is clearly being challenged. And when monopolistic systems face competition, prices of alternative stores of value tend to adjust. Silver's role in this transition is unique because of its dual nature. It serves monetary functions like gold, but also has irreplaceable industrial applications. This creates demand from two distinct sources that don't necessarily correlate. Industrial users need silver regardless of its monetary premium. Monetary demand responds to confidence in fiat currency systems. When both sources of demand strengthen simultaneously, supply struggles to keep pace. The concentration of physical silver in single institutional hands raises questions about how future price discovery will occur. When one entity controls 43% of exchange stocks, plus substantial additional holdings through custodial arrangements, that entity influences market dynamics regardless of intent. Price formation in commodity markets depends on dispersed ownership and continuous willingness to transact. High concentration can reduce liquidity and increase volatility. History shows that the largest wealth transfers occur during monetary regime changes. Those who recognize transitions early and position accordingly can preserve and grow purchasing power. Those who maintain static allocations designed for previous regimes often experience substantial real losses even if nominal values appear stable. The difference between nominal and real returns becomes critical during inflationary periods. A portfolio that generates 5% nominal returns loses purchasing power if inflation runs at 7%. Current conditions don't guarantee any particular outcome. Markets can remain irrational or manipulated far longer than individual participants can remain solvent. But the accumulation of physical metal by central banks, the position reversals by major commercial banks, the structural supply deficits in industrial markets, and the divergence between paper and physical prices all point in a consistent direction. They suggest that entities with long time horizons and sophisticated analysis capabilities are repositioning for a different monetary environment than the one that prevailed over the past 40 years. The choice individuals face is whether to acknowledge these signals and adjust portfolio construction accordingly, or to maintain allocations designed for conditions that may be changing. There's no risk-free option. Holding traditional assets carries risk if monetary conditions shift. Allocating to alternative assets carries risk if traditional conditions persist. The question is, which set of risks aligns better with your assessment of probable futures and your capacity to absorb different types of losses? What makes this moment particularly noteworthy is the convergence of multiple independent indicators. Any single data point can be explained away, but when central bank buying, commercial bank repositioning, industrial demand growth, supply constraints, and physical paper price divergence all occur simultaneously, the probability that something fundamental is changing increases. Understanding these dynamics doesn't require predicting exact prices or timing precise turning points. It requires recognizing that the environment is shifting and that portfolio construction designed for stability may need adjustment to account for increased uncertainty. Precious metals have functioned as monetary insurance for thousands of years across every civilization. Their role hasn't disappeared simply because recent decades saw relatively stable monetary conditions. The time to consider insurance is before events that would trigger claims, not after. Whether current signals indicate imminent disruption or merely increased probability of future instability, the principle remains the same. Adequate preparation occurs when costs are low and options remain available, not when problems become obvious to everyone simultaneously. Markets eventually resolve distortions. Systems built on unsustainable foundations eventually adjust. The physics of finance, like physical gravity, assert themselves over sufficient time horizons. What we're observing in silver markets may be early evidence that long-standing distortions are beginning to resolve, or it may be temporary dislocation that reverts once current stresses ease. The data doesn't provide certainty either way, but the behavior of major institutions suggests they're preparing for the former rather than betting on the latter. And institutions with regulatory experience, market knowledge, and multi-decade time horizons tend to position based on structural assessment rather than short-term speculation. Their actions carry informational content worth considering alongside other available evidence.